Welcome to The Explainer. Today, we're diving into a question that's on every single business owner's mind. What is my company really worth? We're going to break down the two main ways to answer that question using two key metrics, SDE and EBITDA.
I mean, if you're a business owner, this is the question, isn't it? But here's the thing. The answer isn't just a number. It's a story. And the way you tell that story to a potential buyer, well, that can make all the difference in the world.
So, here's our game plan for today. We're going to break down what your business is worth by digging into SDE and EBITDA. We'll put them head to head, help you figure out which one makes sense for you, and really unpack why making that choice is so incredibly important. Okay, let's get right into it. The best way to think about sellers' discretionary earnings, that's SDE, and EBITDA, is to imagine them as two totally different lenses. Each one gives you a unique view of your business's profitability, and crucially, each one is meant for a different kind of audience.
First up, let's look through that SDE lens. This perspective is all about one thing, showing the total, real-world financial benefit for an owner who's in the trenches running the business day in and day out.
So what exactly is sellers' discretionary earnings? Well, SDE is the number that calculates the total cash a single owner truly pockets from the business in a year. It's designed to give a potential buyer a straight answer to their most important question. Hey, if I buy this place and run it myself, what am I actually going to earn? And to figure that number out, you start with your net profit, but then you add back a bunch of other stuff. We're talking about things like the owner's salary, any personal perks you run through the business, like a car, and any weird one-time costs, like a lawsuit, that a new owner isn't going to have to deal with. It basically cleans up the numbers to show the true earning power for one person.
All right, now let's switch gears. We're going to put down the SDE lens and pick up the second one, EBITDA. This metric is totally different. It measures the financial muscle of the business itself as a standalone machine, totally separate from whoever owns it.
EBITDA. I know it's a mouthful, right? It just stands for earnings before interest, taxes, depreciation, and amortization. All you really need to know is that it's designed to show the raw, unfiltered profitability of the business's main operations. Think of it as measuring the pure horsepower of the business's engine, no matter who's in the driver's seat. Now, you'll probably hear folks in the M&A world talk about adjusted EBITDA. Don't let that throw you. It's just a slightly more polished version. It also strips out those one-time, non-repeating expenses to give an even sharper picture of the company's real, ongoing profit.
So we've got these two really powerful metrics, but where do they actually differ? Well, the biggest differences really boil down to how they handle the owner's role and who they're trying to talk to.
Here's the most critical difference, so listen up. SDE adds the owner's salary back into the profit. Why? Because it assumes the new buyer is basically buying themselves a job and will take that salary. EBITDA does the opposite. It treats the owner's salary like any other operating expense because it assumes a professional manager will have to be hired and paid a market rate salary. And in the real world, this is how it usually shakes out. SDE is the language of Main Street businesses. Companies doing under $2 million in revenue that are probably selling to an individual. EBITDA, on the other hand, is for the bigger players, those over $2 million in revenue that are more likely to be snapped up by an investment firm or another company.
So with all that in mind, how in the world do you decide which story is the right one to tell for your business?
Well, it actually comes down to three pretty simple questions. First, just look at your revenue. Are you generally above or below that $2 million line? Second, be honest about your role. Are you the one making it all happen every day, or do you have a management team running the show? And third, who's your most likely buyer? Is it another person like you, or is it an investment fund? At the end of the day, it's about matching your story to your audience. SDE is for the individual who's asking, what's my new salary going to be? EBITDA is for the investor who's asking, how does this asset perform before I have to pay someone to manage it?
Now, this isn't just some abstract accounting exercise, okay? This choice has a direct, tangible, and honestly pretty massive impact on your final sale price.
You see, a business's value is usually found by taking its earnings, either SDE or EBITDA, and multiplying it by a number. That number is called a multiple. And that multiple reflects things like your industry, risk, and growth potential. But here's the kicker. The multiples for SDE and EBITDA are not the same. And here's where the math gets really interesting. EBITDA multiples are almost always higher than SDE multiples. So, for example, a business might get a 3 times multiple on its SDE, but the same type of business might get a 5 times multiple on its EBITDA.
So even though your EBITDA number itself will be lower than your SDE, that much higher multiple can lead to a valuation that's just as high or sometimes even higher. You know, the source material we're drawing from for this explainer just nails it. It says this choice could change your valuation number, your sale price, and who even wants to buy your business. This isn't a small decision. It sets the stage for the entire negotiation.
So what are the big takeaways here? First, match the metric to your business. SDE for smaller owner-run shops, EBITDA for larger, professionally managed companies. Second, understand that this choice is a signal to the market about what kind of buyer you're looking for. And finally, no matter which one you pick, documenting every single one of your add backs is absolutely essential for building trust and getting the price you deserve.
Look, choosing between SDE and EBITDA, it's really about choosing how to tell the most powerful and convincing story about all the value you've built over the years. It's about translating all that sweat and hard work into a language that the right buyer will understand and appreciate. So, that leaves you with one last question to think about. What story are your numbers telling right now?